Hey, so welcome back to a continuation from the previous lesson where we talked about midweek consolidation to Thursday rally or decline model. Yeah, that is a mouthful. I might probably find a better term for this, but the main focus, of course, is the model itself and not necessarily the name. So we left off at risk factors for a model, and of course, I wanted to then go into describing the model itself, and then obviously looking at some examples, and later on, the final videos for each of these models actually that I am dropping would be a statistical based uh, um, sheet. That's gonna be like a sheet, so that would be like the final task for me for these videos. So for each of the models, with the rules and protocols and whatnot, I would do like a 1 to 2 year just back testing of each of them with actual stat or data in terms of their win ratio, loss ratio, average risk to reward, and stuff like that, of course. And that will give you like an insight as to what your expectation of that model should be. Right, but we're going to talk about risk factors for the midweek consolidation to Thursday rally slash decline. So again, what we're looking for with the model essentially is a lack of volatility during the week leading up to that New York session Thursday. So essentially, we don't want to have seen a significant one-sided price delivery, which is the keyword here. The keyword here is a significant one-sided price delivery, right? Because significant one-sided price delivery essentially means the market is not in a consolidation. The market was actually trending. We don't want to see trending market conditions. We want to see the market due to factors like daily time frame being at the equilibrium of a daily range, or daily time frame being in a trapped order flow, or essentially the market just being at the long-term target objective. Usually when the weekly candle opens at a longer-term target objective, like an 8 to 60 objective liquidity or like weekly levels, a lot of times Monday going into late Wednesday, especially with the economic calendar being the line, but most times Monday going into Wednesday would just like consolidate, and then Thursday would be that jitter swing. Typically it is Thursday London session, sometimes it could be Thursday Asian session. And also, if you go and do some back testing, oftentimes FOMC, especially recently, FOMC has been like this, where Monday to Tuesday will consolidate, then Wednesday would have like that whipsaw price action, only for Thursday just to, reverse the other direction and stuff. So these are things that we would actually show in terms of the examples. But in terms of looking at risk factors for a model, the first thing we don't want to see, of course, is that one-sidedness or volatility, right? Because that then increases the odds of one-sidedness during the New York session that we're looking, which is our window of opportunity for this trade. Now remember, this is not a TGIF. This is a trade that aligns us in the direction of daily order flow, right? So that time window essentially where we would expect a TGIF trade, which is that 7 a.m. Eastern Standard Time to noon or 10 a.m. Eastern Standard Time. So that is a window of opportunity to look for this model, right? So again, remember, we require certain elements to be present for us to even think about looking for this model, because again, from data testing, the model only showed up 5 times. Okay, 5 times between the period of Thursday 29th of August 2023 to Thursday 9th of October 2025, right? So between that 2-year period, we only had the model show up 5 times. So this is a model that you're going to use sparingly. Does not mean you should neglect the model, right? But it's just one of the potential models. So when it comes to like a Thursday trading, right, this should be one of the potential models depending on what price signatures you've seen from like the start of the week, like Monday going into Wednesday, right? So depending on the behavior of price action, right? Say we know like Monday to Wednesday was a consolidation, then this model essentially becomes a potential model that we can use to engage with Thursday's price action, right? There's going to be other models that would have somewhat similar qualities, but we would be able to differentiate them, right? Again, the goal is just if we can identify a certain repeatable pattern or signature in price, we should have had a model with a statistical edge to trade that repeatable characteristic in the marketplace, which is why we have individual models for each trading day, for day trades and short-term trades. And honestly, it is a lot of work, but if you can commit to putting all the time in mastering all the models and being able to essentially like memorize them, then you would be absolutely unstoppable, right? So this is what I genuinely feel. Okay, so we have the risk factor number one, lower time for risk factor number one, which is overextension during London session. And then number two, if price turns into a lower time frame objective in direction of our trade prior to entry at session open, so within the first 1 to 2 hours of our session open, if we see the market go to any immediate lower time frame target during liquidity, right, which is in the direction of a trade, we delete any pendulum order. And if we were looking to execute prior to that behavior in the marketplace, we actually did not take any trades. Now let me explain why. Oftentimes the market can, let's say you want to be a buyer, for example. I'm looking to buy US CAD, right? Now there are situations in which you're looking to buy US CAD and maybe your entry is at the order block, but now let's say there is a bullish fair value gap just above your bullish order block, and your limit order was the bullish fair value gap. Or let's say there was a buy some bounce, sell some efficiency just above your bullish order block, right? Now, you set a limit order at the high of that bullish order block, looking for a price to tag you in, and now you're long and you're looking to target maybe a much more premium target like a 4-hour bearish fair value gap or bearish efficiency, right? So now the market misses your order block limit order, maybe trades just a little bit into that by someone else was efficiency just above your bullish order block, and then goes to an M15 short-term high, maybe an intra-session high or intraday high. If that happens within the first 2 hours of New York session or New York open, right? So between 7 a.m., which I should have specified in this example, but between 7 a.m. to 9 a.m. AST time zone, right? So if we see the market trade into an immediate lower time frame liquidity objective in direction of our trade, we do not take continuation trades, because a lot of times, aside this model itself, because we're still going to have the same risk factor for other models, right? But a lot of times when the market trades into an immediate lower time frame target during liquidity, that usually is the jitter swing of this session, right? So when you get the expansion and then you go into the marketplace and maybe you're setting your limit order, or maybe the market takes out that short term high and then reverses aggressively and goes back down into your order block. If you're going to buy in that order block, a lot of times the market's not going to just trade into that lower time from order block and expand back to your H4 bearish fair value gap target objective or sell some bounce by some efficiency target objective. No, the market would actually reference a higher level pull of liquidity. And I know I'm going on a rant, but what we're actually going to do here is I'll just quickly do like a quick annotation of what I'm trying to talk about. All right, so just find like a quick chart that I can use to do my analysis on. So let me explain what it looks like, right? So let's say we want to trade with the model, right? The Thursday rally, midweek consolidation going into Thursday rally decline. We want to trade the model. Now, if we have a reference, a daily range reference that we want to, let's say we want to buy from, right? So we have pre-anticipated that we are going to buy the fair value gap just beneath this M15 swing low, right? So that is the plan. And we have a 4-hour, that's a 4-hour premium array. So we're gonna make it a little bit thicker, right? But now we get into the start of New York session, right? Your expectation is that the market should trade down into your entry level for a trigger, and then of course you're looking to ride back above any short amount that would form, right? A short amount like this. Now you, within the first 1 2 hours of session open, this is where you want to see the market trade down into, but the market does not trade down into this, right? And what happens is the market goes up like this and comes back like this. And now you're maybe thinking to yourself, okay, we have new structure in price. Let me go and buy this, right? Because we have displacement away from there. So I'm gonna go and buy this as new structure, or I might go and buy this as, you know, let me just wait for the market shape beneath this slow down here, whatever. Here's the problem. In a situation like this, if you miss this initial rally, if the market is going to most likely continue to be bullish, right, you wouldn't want to see the market lose this low down here. But oftentimes, when the market expands like this and then has no follow through, right, that's the main thing here. Within the first 1 2 hours of that New York session open, when we see that rally like this with no follow through, we usually don't want to go back in looking to trade aggressively, because what we've had here is a clearing of buy-side liquidity, right? Now, oftentimes what the market could do with this is the market would go and reference a higher level discount. So maybe you're focused on an M15 swing because you're maybe day trading, right? Or you're maybe focused on an M30 swing because you're day trading, not realizing that all of this swing originated from, let's say, a H4 bullish inefficiency or H1 bullish order block. So now let's assume down here that we have a H1 bullish order block down here, and you're so locked in on this M30 or this immediate price swing that you don't realize the fact that a hyperability expansion is an expansion that wants to reference external range liquidity. And I just dropped a bomb here, right? A high probability delivery expansion is an expansion that does not want to return back to previous dealer ranges. It wants to seek new dealer ranges because it needs that sponsorship. That's what we want to see for hyperbolic expansions, right? So when we have a situation where the market leaves an existing dealer range like this low to the side here, right, especially after a little bit of consolidation or expansion away from a discount array, when we see that return back into the dealer range, a lot of times that can lead to a much more deeper clearing of liquidity, and you get a situation like this where if you're buying inside of this range or inside of this range, you are getting stopped out, only for the market to go into London close, reverse, and continue all the way higher. All right, which is why for that specific window, New York session or New York open, right, if the market expands above a lower time frame immediate general liquidity, does not necessarily have to go all the way to target objective. Just the fact that it is expanded above pre-existing lower time frame dealer range, that moves your trade from high probability to low probability, and in that situation you seat your ass on the sidelines. You do nothing. Right, number 35 risk factor, of course, is intraday asymmetry between DXY bonds and the majors. Like I've talked about before, symmetry is a function of order flow. When liquidity, when money is being poured into an asset class, that would reflect, right? That institutional activity would reflect across correlated markets. So when we have a situation where we're seeing a lack of correlation between assets that are supposed to be closely correlated, like dollar and UST bonds, and of course the majors, USDJPY, Aussie dollar, cable, and the rest of them. When we see a lack of symmetry between them, then that already screams low probability. It screams that we're not trading in a market that is poised to be one-sided, because a market that is poised to be one-sided would see correlation and not a lack of correlation. This usually it's a really significant risk factor, which a lot of traders do ignore, and myself sometimes too, right? And I do pay the price for it when I do ignore this risk factor. So a modification to the model here is that it is also a no trade, right? So for overextension, it is no trade. For this, it is a no trade. For intraday asymmetry between dollar, bonds, and majors, it is also a no trade on the majors, right? So if you are trading the majors, then this is a no trade. And obviously number 4 is NFT Friday or High Impact News Friday. Now this one specifically is not a no trade, but essentially it is important to be aware of this being a risk factor. So when you have that expectation and then going in and trade the model, because again, I'm not trying to come and tell you that the model is foolproof and you're never going to take losses. You will take losses, right? But it is important to understand what the context is, so that saves you from going back into an over trade or over leverage or overexerting yourself, when you can just realize we're having a P tomorrow and actually just literally sit my ass on the sidelines until after NFP and look to see if there's opportunities in the marketplace, versus trying to go and trade aggressively and then you just get stuck. And you get stuck in a back and forth on Thursday and lose a lot of equity trying to catch a move, only for Friday to come and offset all of that asymmetry in the marketplace, and now you get clean moves in price. So the first 3 are all risk factors in which you don't engage with the markets whatsoever. And of course the last one, number 4, is something that is much more discretionary, especially if your trades do not play out. Now remember, the risk profile for this model is a short-term trader's profile. Okay, we're not day trading in this model, we are strictly short-term trading. All right, so that is the plan here. Now let's discuss the actual entry model for our Thursday middle consolidation to Thursday rally / decline. Right, so we have 2 entry models. The first one is a standard OTE profile, right? And the second is the offset accumulation type 1 model. So we're going to talk about both of them. But now I want you to understand that for every subsequent lessons or videos, whatever, every other entry model will fall under either of these 2 categories for the most part, right? So we're either going to be, especially for day trades, we're either going to be looking at a standard OTE profile, which I'll talk about shortly, or we're going to be looking at an offset accumulation model, which has a type 1 entry, type 2 entry, and of course a type 3 entry, right? So let's talk about the first entry model, right? The standard OTE profile. So OTE stands for optimal trade entry, right? So optimal just simply meaning, if I want to be a buyer, I want to buy where it is most optimum for me, which is a discount. If I want to be a seller, I want to sell where it is most optimum for me, which is a premium. Essentially, OTE essentially means, I've said essentially so many times, OTE means, buying at the most suitable prices. I like to call it fair valuation. So for me, optimal trade entry is simply fair valuation. What would I deem as a fair value bargain if I went to align with my thesis, right? So the first model here is the standard OTE profile. Now what you can see here with that standard OTE profile is, again, remember, a model is that middle consolidation to Thursday rally / decline. So I used bullish examples for this lesson specifically. Now what you can see here is between Monday to Wednesday, we had that back and forth. The market was not really doing anything. So as long as we can see that lack of one-sidedness between the days of Monday going to Wednesday, that creates a potential for our specific model. Now what we're looking for, it is really specific with the model, which is a good thing about this model, right? We're looking for specific, what I like to call triggers, that is a clearer, like a lighthouse blasting sign saying this is your model. Focus on trading this model, right? So first off, we're looking for consolidation between Monday to Wednesday, and then on Thursday we want to see the market trade out of that consolidation. That's our trigger, right? That is our Judah swing for the week. Imagine this being like a Monday consolidation to Tuesday false expansion, right? But in this situation, Monday to Wednesday is their consolidation, and then Thursday initiates. Usually it's going to be Thursday Asian session or Thursday London session, but that initiates the Judah swing. And then you get your initial displacement. Now, what we're looking for with that displacement is a break in structure. That structure shift confirms we have trapped liquidity down here. We're seeing the shift in structure, so anyone who was shorting, the algorithm is going to seek their buy stops. So what we do here is we wait for the market to return back down. Again, because we're short-term trading, we are not going below the M30 time frame. So our entry PDA, so PDA meaning premium discount rate, has to be on either the H1 time frame or M30 time frame, or if you want, you could actually do an M45 time frame. Now, the reason why there's this restriction here is because the model really accounts for the potential for much more violent stop runs, which is more common on Thursday New York sessions, where the market can have really aggressive stop runs, spikes that does not invalidate theses. But if you're a day trader, essentially, you just get caught in a situation like that. Now, of course, there's models for day trading on Thursday, right? But this specific model is simply accounting for the fact that you can get a lot more aggressive retracements or reversals in the marketplace. So we focused on short-term trades. So by focusing on the M30 time frame or H1 time frame or even M45 time frame, our stop losses would account for that potential risk factor of slippage, right? So what we have here is we wait for that market structure shift on the M30 time frame or 1 hour time frame. We wait for that retracement. Ideally, we want to see the market retracing from London lunge going into New York session. Generally, what we want to see is retracement going into New York open. And then at New York open, as the market trades lower, what we're looking for is the order block or fair value gap that initiates that one-sided displacement. Like I've told you before, I've said this in so many videos in the past, right? So you should by now know what I'm talking about, right? We're looking for that order block or fair value gap that initiates that one-sided expansion. That becomes our entry PDA. That is number one. That entry PDA has to come between your 71% Fibonacci level to 79. Your 6 to 2% Fibonacci level to your 7 to 9% Fibonacci level. So that is your 618 to 786 Fibonacci level. That is your range where you're looking for that specific signature in price, and that is your entry level. And your stop goes 3 pips below the order block or the Dillon range that initiates that expansion. So I'm going to show you what it looks like with an example from as recent as 9th of October, which is last month actually. So again, we have the same profiles or signatures in price here, where you can see we open on Monday, back and forth consolidation profile, going into Tuesday, same consolidation profile, going into Wednesday. So what we're actually going to do here is we're going to look at the economic calendar for this specific weekly trading, right? So the week starts on 6th of October and ends on actually it ends on 10th of October. So we're going to go and take a look between 6th of October to 10th. Okay, so if we study the data here, you can see on Monday we only have interested announcement on pound and euro, none on dollar. Okay, on Tuesday we have a medium impact on Canadian dollar, right? Not again, interest announcement or something major like maybe CPI or something. On the Wednesday, we had FOMC meeting minutes, right? Now remember, it was around the period where we had the government shutdown, so that means your typical numbers release, stuff like this, they don't factor, right? The reason why they don't factor is because the government is shut down. But when we have this, Fed chair speaking, right? If you go back and check, for most of the government shutdowns, it was usually the Fed chair speaking that had the most influence in terms of volatility, right? So we can ignore all of this because, again, we don't expect them due to government shutdowns. So the data is usually not gonna be released because the departments in charge of them are, they're on strike. So they can't release any data or nothing, right? But again, because the government is shut down does not mean the Federal Reserve is shut down, right? So that does not affect the Federal Reserve. So when you have speeches like this, they are pretty significant, especially when we have a situation where there is the government shutdowns, right? So again, if you look at the entire weekly calendar, right, the only significant economic releases we had to worry about was on Thursday, which was that Fair Share speech, and Friday, which was the unemployment rate on Canadian dollar. Now, remember, the government shutdown does not affect Canada whatsoever, right? So that is still solid. That is still ongoing. So we only literally got Friday and Thursday for those key economic releases. So now what you can see here is we're already seeing some of the conditions that aligns for our checklist, right? You can see here for our weekly profile, we're looking for Monday to Wednesday to consolidate, and we're also looking for a lack of major economic driver early during the week. It helps us see that the model is forming, right? So you can see during the week we don't really have any significant economic releases. So between Monday to Wednesday, there's nothing really that significant until Thursday, right? So it helps that we have higher impact economic releases on Thursday. It also helps that we don't have significant economic releases between Monday to Wednesday, because now if we start to see consolidation early in during the week, we can just attribute this to the fact that we have the major economic releases on Thursday and Friday. So we essentially just wait until Thursday, New York session or New York open. Between that period of Thursday New York open to Friday London close, that becomes the window of opportunity to look for any potential trades. And again, we're going to talk about models for Friday, right? But for this specific model, we would like to see a lack of economic data between Monday to Wednesday, and that is further emphasized when we see much more significant economic data or speeches coming out between that Thursday going into Friday, of course, right? So now what you can see here, that came out at 8:30. Again, I don't want you to really focus more on the time. I just want you to focus on the logic of the model, right? So now what you can see here, let's see actually what is going on in terms of key levels on the daily time frame, why we would be bullish, and examples like that here. Now you can see here overall the market was bullish. Like, just if you conduct a IPTA 20, 40, or 60 back study, you can see that overall data was generally just bullish in price. So of course we're bullish on dollar CAD, and we have this eye here, right? So this eye was the swing guy that initiated all of the rally, or not rally, all of the decline lower, right? So we have that eye there as our swing guy in price. So the market drops lower. We have a little range here. The market trades down to bullish order block one more time. Also taking out rejection block, expands higher, break a block, pseudo break a block, actually trades back down, fair value gap, break a block, a bit of consolidation, displacement change of delivery into bullish order block, propulsion block, expansion, propulsion block, sells off, takes out self stops inside fair value gap, expansion. So you can see the overall narrative here is excuse me, every time we retrace to take out a major sell stop, the market responds with bullishness, right? So we know the market's bullish, and you can see we're pretty close to this 12th of May high here on the ESCAD. Now, in terms of a daily time frame level, what we had here was that daily bullish order block. Right, so we had daily bullish order block in here, and essentially what you can see here is the market just consolidating inside that daily bullish order block. Now, if we go down to the 1 hour time frame profile, you can see all of that consolidation there. Now, if you look a little bit closer at USD in terms of narrative, we have the slowdown here, and then on Monday we create the low. Tuesday clean lows down here. The market takes short-term highs into bearish order block, takes out the lows. Again, you can tell every time the market goes above a short-term high, there is no follow through. Every time we go below a short-term low, there's no follow through. These are signs that I've taught you as early signs of consolidation, or signs of the market being in a seek and destroy profile. So we have a bunch of back and forth, and on Wednesday the market takes out sell stops, right? Again, we don't care about this on Wednesday, because again, our model is on Thursday. It is on a Thursday. It is a middle consolidation to Thursday rally or decline. So we want to see that Judah swing come on Thursday, which is what you get here going into London session. So going into London session, inside that daily bullish order block, we take out the rejection block from Wednesday. So all of this range that's your midweek consolidation profile. That's your trigger, your stop run trigger, below rejection block. Market structure shift. Focus is on where did we start to see that initial one-sided expansion? Where was the fair value gap or order block? You can see the market trades like this, slowly like this. Again, and all of a sudden, boom. The moment it expands like this, it can change one-sided with pretty significant candles. So now we understand that the fair value gap where we started to see that one-sided expansion was inside of this. So that becomes our entry. And then for stop loss, it has to go 3 pips below the swing low that initiates our swing expansion, right? Lower time for swing expansion. So we have this. 8 plus 3 is 11. That's a stop. And then we can now target a 1 hour time frame liquidity draw in the direction of that daily time frame. Target objective, right? So that's what we're looking for. And that is your model number 1, standard OT profile. And for our entry profile number 2, entry model number 2, now here we have the same profile, the same conditions as in entry model number 1. Monday to Wednesday consolidation profile, which engineers liquidity above and below the marketplace. Oftentimes between Monday to Wednesday, or between Tuesday to Wednesday, the market would run those pools of liquidity, albeit on a shallow basis. Because again, the overall concept is that we engineer liquidity between Monday to Wednesday, and then Thursday is the trigger that then initiates the expansion phase, right? So what you get here is we have that low from Monday to Wednesday, where the market, again, this is all for bullish examples. On Thursday, the market trades below that low, right? We get some kind of SMT divergence with your reference asset. So if this is just a CAD, you're looking for SMT essentially with dollar DXY, because that is your reference asset, right? So you're looking for some kind of SMT confirmation down here with your reference asset. And unlike the first example, you're not waiting for a break in structure or a market structure shift. You're waiting for a change in state of delivery leading up to New York session, right? So just before New York Open or at New York Open, you get that confirmation with both. I like to look for interbank combined with institutional change in sale delivery. Now, like I've said before, I've told you before, interbank change in sale delivery is when the market invalidates previous fair value gap by inverting them. So when you start to get your inversion blocks, not inversion blocks, invert the fair value gaps, right? That is your interbank change in sale delivery. And of course, a institutional change in sale delivery is when the market qualifies a bullish order block, right? So these are signatures I'm looking for. Again, same stop loss principle of 30 pips below the swing low, where you see that initial expansion that initial expansion that essentially gives you a change of delivery plus inversion gap, right? So you're looking for a combination of an inversion gap plus order block, right, as your entry level. And ideally, I like to look for a lower time frame SMT, right? So we're looking for an overall SMT on that 1 hour time frame swing, right? The Jada swing that makes the low of the week. And for our entry, right, we're looking for a much more shorter or smaller SMT profile. Now, if I'm not going to get the SMT divergence here, I usually like to go and take a look at T-bonds. Right, so if I get SMT divergence on T-bonds at the highs, meaning that they're going to sell off, that means that dollars should rally, and USD CAD in this example should also see significant rally for our 1 hour to 4 hour target objective, because again, we're short-term trading, not day trading. So this is called offset accumulation type 1. Now, before I continue with the model, I do have to do a video on entry patterns. All right, so whenever I talk about offset accumulation type 1 or 2 or 3 or standard OTE entry, you understand what I'm talking about, right? So yeah, and I do think that is all for model here. Now, what would follow up would be examples. Examples where I would just make them super short because we already understand the model. And I'll just point out main factors for, we're going to have examples for when the model was profitable and when the model was not profitable. I think it was only one time where it failed between in the last 2 years. So we're going to have to pull up all the data and stats, and that would be whenever we talk about this specific model, it's going to be with a bunch of examples and also some stats. Right, so in the meantime, you guys stay safe, and I will see you in the next one. Peace.